Okay, let's look at investing in the stocks or equities of another company and account for them either using the cost method or the fair value method. So this can kind of get a little confusing. We're talking about a situation where we own between 0 and 20% of another company, so we assume no significant influence exists. Our book says we're going to use the cost method. Well, we really have three options if we own between 0 and 20%. We can use the cost method. We can put them on our books for what we paid for them and never adjust them. This would be appropriate if it's a small company and the stocks don't trade all the time, so we really don't know what our shares are worth. The second option, which is the one that we're going to use almost all the time, is the fair value method. So we're going to put these things on our books at what it cost us, but then we're going to adjust them periodically so they show up on our balance sheet at their fair value. The third is the fair value option. And our book doesn't talk about that, but anytime we get a new security, a new piece of debt, a new piece of equity that we put on our books, we can say to the world, we're going to account for this using the fair value option, and we're going to mark it up and down, and those ups and downs are going to be part of net income. All right, so let's start out with the cost method. Let's assume we buy 1,000 shares of Beal Corp common stock at $40 a share. That means we paid $40,000. Cash is an asset. It increases with debits. It decreases with credits. And stock investments is an asset that increases with debits and decreases with credits. And if it's something that we're going to sell within the next year, it would hang out in our current assets. If it's something we intend to hang on to longer, it would hang out in long-term assets below our current assets. So let's assume that Beal Corp is a small company. Its shares aren't actively traded, so we have no idea what these things are worth. So August, September, October, November go by, and at the end of December, they pay us a dividend. So they pay us $2 per share. We own 1,000 shares, so that's $2,000 of cash. Cash is an asset. It increases with debits. And dividend revenue is an other revenue and gains account that appears on our income statement. Revenue accounts increase with credits. So then February 10th comes along, we decide to sell these shares. We sell them for $39,000. They were on our books for $40,000. So we've got a $1,000 loss, and that loss will show up in other expenses and losses on our income statement. In other words, not part of our operating income. That's all there is to the cost method. Now let's look at the fair value method. When we first buy these shares, we'll designate them either as trading shares, which means we're going to actively trade them. We're telling the world we're smart. We can make money buying and selling these things in the short run. Or we can designate them as available for sale. So let's pretend we call them trading shares. Then what's going to happen is every day, every week, every month, every quarter, whatever is appropriate for our company, we're going to have to, I say, mark them to market. We're going to have to put them on our balance sheet at their fair value. We'll look at the Wall Street Journal, we'll look at Yahoo Finance, whatever it is, we'll figure out what our shares are worth. And if they're worth more, we'll debit an account called fair value adjustment. And if they're worth less, we'll credit that account called fair value adjustment, and it's a subsidiary account of our account called stock investments trading. And the corresponding debit or credit will be part of net income. So if it's a trading security, unrealized holding gains or losses are included in net income. If, on the other hand, we classify these as available for sale securities, that means we're not going to actively trade them. We're not saying to the world we're smart and we can make money in the short run. We're saying we had a few extra bucks lying around, we invested in this stock because we get tired of earning 0.5% in the bank account. And so what's going to happen is we're still going to mark them to market in the meantime, like I say, every day, every week, every month, every quarter, whatever is appropriate for our company. And the corresponding debit or credit is not going to show up as part of net income, but part of an account called other comprehensive income. And I like to think of other comprehensive income as stuff that hasn't happened yet, but it's so important we've got to tell people about it. Other comprehensive income can be things like excessive gains or losses in our pension plan assets, translation adjustments when we have foreign operations, or in this case, unrealized holding gains or losses on available for sale securities. Beginning accounting textbooks are going to skip this step here, and instead they're going to talk about unrealized holding gains or losses as an equity account over here. And what they're really talking about is a sub-account of accumulated other comprehensive income. So as our available for sale securities go up on the left-hand side of the balance sheet, our unrealized holding gains or losses are going to go up on the right-hand side of the balance sheet. As our available for sale securities go down in value, this account is going to go down in value on the right-hand side. And one of the tricky nuances of the fair value option is we have to avoid double counting. So, for example, if we had classified these guys as trading securities, presumably we already wrote them down to $39,000 and already took that $1,000 loss as part of our net income. So the topic of avoiding double counting on unrealized holding gains or losses is one for intermediate accounting. All right, hope that helps.